Good afternoon. I'm David Snyder, President and CEO of the Economic Club of Chicago, and thank you for joining today's program. The fall leadership dinners are a club favorite and certainly one of mine because it's an opportunity to meet with fellow members in smaller groups and discuss important and timely topics facing both Chicago and our country. Fewer are more important than the growing wealth gap, a crisis that threatens both the quality of our society as well as the future economic growth and prosperity. In addition to the natural consequences of the wealth gap, disparities in healthcare, education, crime rates, and overall happiness, a recent study by McKinsey Company highlights the dampening effect it will have on consumption and investment. It will cost the U.S. economy an estimated loss of between $1 trillion and $1.5 trillion in the period between 2019 and 2028. Now that's equal to 4 to 6% of the estimated 2028 GDP. We welcome our panel of experts today to discuss this complex issue. And following the panel, members will dive into the topic during those small breakout discussions. We hope to shed light on the wealth gap and provide you or your business actionable ways to get involved in addressing the issue. Their full bios can be found on our website, but let me briefly introduce our moderator and panelists. Dr. Helene Gayle is our moderator and fellow member and director of the Economic Club. Since 2017, Helene has led the Chicago Community Trust, one of the nation's oldest and largest community foundations. Under her leadership, the Trust has adopted a new strategic focus on closing the racial and ethnic wealth gap in the Chicago region. Horacio Mendez is president and CEO of the Woodstock Institute, a leading nonprofit research and policy organization focusing on fair lending, wealth creation, and financial systems reform. Horacio recently relocated to Chicago from San Francisco when he joined Woodstock as its first Latino leader. Shelley Stewart is a partner at McKinsey Company and a leader of the firm's private equity and principal investors practice. Alongside his client work, Shelley co-leads McKinsey's research on Black economic mobility in the United States. He has published numerous articles, including co-authoring the report we sent you in advance on the economic impact of the closing racial wealth gap. Before we start the conversation, I'd like to strongly encourage everyone to remain on after the panel for small group discussions. Before we get started, I'd like to ask everyone to change their view at the top of your screen to the speaker view until you join the small breakout groups. With that, I turn things over to Dr. Helene Gayle. Helene?
Our panel today to talk about this issue. And as you said in your initial comments, the wealth gap is one of the biggest issues facing our nation. And we at the Chicago Community Trust, as we were looking at the ways in which we could have a sustained impact here as the region's community foundation, we looked at a lot of different issues that we could have focused on and decided to focus on closing the racial and ethnic wealth gap because, as you mentioned, it's kind of the underlying issue to so many of the other challenges that we face here in the Chicago region, whether it's life expectancy and the health gap, whether it's lack of access to high quality education, violence, etc. All of these issues, if you look underneath, this issue of the wealth gap is an incredibly important underlying issue. Besides that, and we know what it does to the people in the communities and robbing people of their opportunities, we also know that in a region where 2/3 of our population is African American or Latinx, that we cannot expect to move forward economically as a region unless we pay attention to the fact that there are large parts of our population who aren't able to enjoy economic opportunity. So, we felt that it was important to focus on the racial and ethnic wealth gap because it's the right thing to do. It's the best way to give people who have not had the kind of economic opportunity have those opportunities to raise their families and have a good income and have assets to pass on. But importantly, it also makes a difference for our region as a whole. And I think the data that are starting to come out about what difference it could make to the U.S. economy, trillions of dollars that could be added back to the U.S. economy by closing the racial wealth gap. I think it's important because it's the right thing to do, but we also know it's the smart thing to do for our economy. We have taken on a 10-year strategy where we're focused on increasing household wealth, focusing on catalyzing neighborhood investment, and then collective power at the community level. And those three areas are what we're going to focus on as we continue in our work. And also, I think we also all recognize that the impact of COVID, which has disproportionately impacted communities of color here and around the nation, has put a certain urgency to the work that we're doing around closing the racial and ethnic wealth gap. So I just wanted to say from the perspective of the Chicago Community Trust why we're focused on it. I would just say personally, as an African-American woman and as a physician, I've had the opportunity to get a good education, have a good career, but I see so many people who look like me, who come from communities that represent communities of color who have been denied that opportunity. And so personally, I also think of it as something incredibly important. And as a physician, I also recognize that if we could make a difference on closing the racial wealth gap, we will save many, many lives and extend lives and be able to give people the high quality of health as well as overall standard of living. So I'm going to just turn it over to both of my colleagues to also say a little bit from their perspective, from their organizational perspective, and maybe anything that you want to add personally about why this issue of the racial wealth gap for McKinsey and for Woodstock, and what is the organizational perspective from your standpoint. And then we'll get into some of the questions. So Shelley, I'll turn it over to you.
Thank you to the ECC, and thank you, Dr. Gayle, for moderating this discussion with us. I think you hit the nail on the head with respect to the importance of the wealth gap as an unlock to address many of the other social issues we're facing. And I think no one can deny that the pandemic has brought that into particularly sharp focus when you look at the disproportionate deaths of African Americans and other communities with respect to this virus. And unfortunately, it was very knowable at the beginning of the pandemic that would be the outcome. So just a little bit of perspective on where we come from as McKinsey and me personally. We've looked at this issue from two discrete angles. One is at the micro level, and you may have seen some of the work that we've done on Diversity Matters, which we basically quantified the impact, the benefit from individual institutions from getting diversity right. The more ethnically diverse, the more gender diversity, the better the financial return. So that's at the micro level. We've also looked, and it was referenced here at the macro level, at what the dampening effect is on the US economy of large wealth disparity. And that number was at around 1.5 trillion of foregone GDP annually by the time we get to 2028. And others have quantified it and found similar things. So the reason that we as a firm are focused on this, I believe, is twofold, and I've been saying this a lot more recently. One is bottom up. We have a group of very passionate colleagues who may not even be doing this kind of work in their day job, but recognize the tremendous platform that McKinsey offers to start important and difficult dialogues with a diverse set of stakeholders, whether it be in the private, public, or social sector. And so there's this groundswell of grassroots momentum inside of our firm that has been advancing this discussion. But as an institution, we feel that it is very aligned both with this moment, but also with our purpose and our mission. Our purpose as a firm is to help create positive and enduring change in the world. we believe that greater economic prosperity, again, both at the micro level, the company level, but also at the broader economic level, is enduring change that is positive, and that we believe that we are uniquely situated to engage our clients, not just on philanthropy, but also on market-based solutions that are win-wins for our clients, but also go to address economic disparity. And so in that spirit, we've continued to accelerate our efforts here, and we've been delighted and amazed at how much interest there's been from clients across all sectors, in the private sector as well as in the public and social arenas.
Great. Horatio, from the perspective of Woodstock.
Yes, thank you, Helene, and good afternoon. Thank you, everybody. When I first got to Chicago, which was just a few months ago, I was a little disappointed that the welcome wagon was in quarantine. Although I heard that you're not much in Chicago unless people know who invited you, I felt that the history and the legacy of the Woodstock Institute might buy me some time to learn to stand on my own 2 feet in this great city. What I didn't anticipate was that I'd be on a panel with the two of you talking to hundreds of the city's most influential and accomplished individuals about the city's wealth gap, actually before I figured out where to get a good, strong cup of coffee. So with that said, I'm humbled and honored to talk about what I think is the most important topic that we could be discussing today. We're at a very exciting moment, I feel, and it speaks to the leadership and the membership of the Economic Club of Chicago to have a discussion essentially on racism in the economy. This issue is why Woodstock exists. This issue is why I drove halfway across the country in a pandemic to lead Woodstock for this cause. Our reason for being is to build an economy that gives everyone the opportunity to achieve economic security. We've been doing this for 50 years. And it's been a tough slog. There have been some successes. We've focused on the infrastructure that runs our economy. We do this by jackhammering our way down through all the calcified layers of unfortunate decisions that built it. And we want to rebuild it brick by brick in a manner that reduces the wealth gap at scale. Sounds simple, I'm sure, but it means doing a lot of research on how current systems create economic inequality, collaborating with stakeholders on how to address these systemic barriers, advocating for policies with the greatest chance of substantively reducing the wealth gap, and then assessing the effectiveness of policies. Like I said, we've been doing this for 50 years. We've had some big wins like the Community Reinvestment Act and the Home Mortgage Disclosure Act. But we recognize that there's a big gap between legislative intent and effective implementation. If that gap didn't exist, many of the problems we're facing today, that we're talking about today, would have already been faded into the history books. So I'm lucky to be able to hit the ground running with a great team and great partners, including the Trust. Our advocacy work has moved the needle on some of the wealth gap issues, like regressive fines and fees here in Chicago, although there's still much to be done there. Our policy work is now focusing on limiting the wealth that predatory lenders strip from Black and brown families in Chicago and throughout Illinois. And the Trust is a
We'll get into some more of that. Yeah, we'll get into some more of that too. So, yeah.
And our research team is looking at about 40 years of lending data in Chicago. So I think it'd be fair to say we're not spectators in this battle. And I'm actually here today to recruit more combatants. But one of the things I want to emphasize, and I'm hoping to get to this in some depth during our conversation, is that it's not hard to figure out where all of this problem started and what's causing it, if we're willing to be honest with ourselves about how the infrastructure of our economy was built and who it was built for. What won't be easy, at least in the short term, is rebuilding a new infrastructure. But we have to do it if we want to build a resilient society, and we have to do it if we want to build a sustainable and growing economy. So thank you. Back to you, Helene.
Great. No, thank you. And you touched on a lot of things that we're going to get into in the conversation. So I didn't want you to give it all away up front.
I got plenty more.
I know you've got plenty more. So Shelley, back to you. So I know people have had a chance, hopefully had a chance to look at the study some. and it's been out for a while, and it grabbed a lot of headlines, and for some of the reasons that you said, why McKinsey, and why is McKinsey thinking about these issues? So, without going into all of the study, what were some of the biggest takeaways? And then what were some of the things that maybe also surprised you a bit? I think all of us who are steeped in some of this work still find some of the findings still pretty shocking.
Yeah. Absolutely. So first and foremost, I think that the headline number, just in terms of how big the dampening effect was, even surprised our team. Intuitively, we understood that if you have constrained human potential, that hurts GDP over time. But I think the magnitude of the number, given the size of the population, which is meaningful in absolute terms, but still that was surprising. That's one. We wanted to make sure, given how big and complicated the problem is, that we went at a pretty granular level and looked across what we call the wealth building journey, right? That starts when someone's born and they either inherit something or they don't. And it ends at the end of that journey when they're able to pass something on. And there's a whole bunch of stuff in between, whether it has to do with wealth development, with business ownership and home ownership, implications for education, both K through 12 and then higher education, employment and pay, access to financial services. The thing that was surprising is that we found gaps across all of the discrete wealth building journeys that we could map. So it was very difficult to find any places where there wasn't a substantial opportunity for improvement. So the good news is that we know where to look. We're actually spending a little bit of time right now trying to develop a more analytically rigorous perspective on what might move the needle most substantially. But again, I think it was surprising that there was opportunity to close wealth or gaps on the wealth journey across all stages. As I also think about the research and some of the subsequent work that we've done, I was also surprised at how much investment, quote unquote, is in different forms, whether it's in kind or actual dollars or programs, is going to try to address different aspects of the wealth gap. And yet very little progress empirically, if you look at wealth and income, has actually been made over time. So that was another thing that surprised me. And there's a whole bunch of thinking as to why that is, but there seems to be a desperate need for much more collaboration and coordination, much more thoughtful scaling of things that are working and faster mothballing of things that are not. And so that was the other thing that surprised me, is that there are actually, from a private sector and even from the public sector, there are things that are chasing this opportunity. I think there's substantially more investment needed, but the lack of coordination seems to be contributing to incremental progress.
Yeah, and I want to get you in there in a minute, Horacio, on some of this, and I think it relates to some of your issues around systems. But let me ask you a couple of more questions, Shelley, about the study specifically. So, one of the things that I think people don't recognize is that the wealth gap has been growing. And, we all think about the progress that's being made. And obviously, COVID, we know that, COVID is a specific example of a reason for the wealth gap increasing. But even before that, it was increasing. Could you talk a little bit about that,
Sure.
what the factors were, and what you found in terms of the direction that the gap was going?
Yeah, a couple of things. So first, set aside the pandemic or other exogenous events that we know historically tend to widen the wealth gap. The normal trajectory of the wealth gap, even minus those, is at best staying stable, but often widening over periods. And there's a whole bunch of factors. But part and parcel is, I think is very intuitive for this group, is that wealth creates wealth, right? The return on capital in different economic environments is quite high. So when you're wealth poor, we have 1/10 the wealth, which the median black family does when compared to the median white family. That's a major disadvantage because you don't have that basic endowment to build on. So it becomes a little bit of a vicious cycle and hard to catch up because of that wealth endowment that is missing up front. And we could get into all the historical reasons for that, but I won't do it on this call. The other thing, though, is this point about the pandemic. And in my opening, I said it was very predictable what the health outcomes would be for Black and brown communities. It was also and remains very predictable what this will do to the wealth gap in this country for certain communities. And one of the biggest reasons for that goes back to this lack of ability to withstand any sort of crisis. The median Black family has about 5 days of liquid savings saved. 5 days. I mean, you all know how deep we are into this pandemic. So almost no ability to withstand whether it's a big natural disaster like a hurricane or a health pandemic or even something smaller where they lose their job temporarily or get furloughed. And so there's myriad factors that build on one another that make it such that in normal times the gap stays constant or widens, and then it gets exacerbated much more quickly when some of these exogenous events happen.
One other finding that I also thought was very revealing was this issue around falling out of the middle class. And that if you look at Black families, 7 out of 10 Black families, Black Americans who were born into the middle class fell out of it during their lifetimes. Why is that? What accounts for that doing worse by each generation as opposed to going in the other direction, which we think about as the American dream?
Yeah, I think it's a great question. And the mirror to that is that if you are a Black American that is born in the lowest income bucket, you only have a 1 in 4 chance of even making it to the middle class. So objectively speaking, there is no participation in the American dream for the average Black American. And that's just empirical. I think there's a number of factors, but some of the I don't want to get into, I'm not a race theorist, right? I do my work grounded in economics and markets, but some of the leading work on this suggests that it's that racial animus that's embedded in a lot of our different institutions has specific implications for the way Black individuals, men and women, interact with the education system, with the healthcare system, and with the employment market, and unfortunately with the criminal justice system. And so there are deep things embedded in our institutions that we're obviously having a proactive discussion about as a society. But I do think that finding, which was not original McKinsey finding, but is one of the most important things that's come out, is it's not just an economic issue. Even if you start with an economic head start relative to the average, you don't have a very good chance of maintaining that if you're Black.
So, Horacio, you've done a lot of work on systems and how, kind of how we got here. Talk a bit about how you, from Woodstock, as well as your experience in California, have viewed some of these kind of systems issues, and what does that mean for how we have to think about making changes to reduce the wealth gap?
That's a big question. I've been trying to I've been racking my brain trying to figure out how to be able to answer questions like that succinctly for years. Let me give you a quick example. Taking into consideration that it's Veterans Day, which is a good day to look back and to give thanks to people that have sacrificed for us. Let's use the GI Bill as an example. So the GI Bill sparked a period of remarkable growth in this country. Unfortunately, the bill gave power to local authorities to administer the program, which opened the door, unfortunately, for racism to find its way into how it was implemented, something we've seen repeatedly in our history that Shelley even touched on. As a result, Black veterans were pushed into vocational programs that led them to jobs at places here in Chicago like U.S. Steel Southworks or the Wisconsin steel plants and other big factories that eventually closed down or moved away. Now, this prevented the Black community in Chicago from building the same level of wealth as their white counterparts during a booming economic time that many look back on fondly and thought of when they wanted to make America great again. So Even at the education system, when there are benefits that are made available, it's baked into the system with regard to the hierarchy of values in the systems here. That there are some lives that have a little bit more opportunity, or in some cases a lot more opportunity than others. From the financial services perspective here in Chicago, in the decades leading up to the 70s, between 75 and 90% of homes sold to Black families in Chicago were sold on something called seller contracts. This is where people would pay the property owner in installments because they couldn't get a bank loan. Now, buyers didn't build any equity in these homes until the contract was fully paid off, which was pretty difficult to do given the interest rates. And buyers who defaulted were left with nothing. So in the 1950s and 60s, which is a period where most white families built intergenerational and transferable wealth in the form of good paying jobs with benefits and pensions, thanks to their education financed in part by the GI Bill, and the purchase of property. That's the kind of wealth that determines their kids' ability to go to good schools, own their own homes, or even start a business. In this period alone, between $3 and $4 billion were stripped from Black families in Chicago. That is a startling amount when I read that. But where did that wealth end up? What does that mean to our positions regarding the distribution of wealth? If much of that wealth was built through what I learned as an economist, is a market disruption. So the systems really is something that Woodstock is focusing on, not just the expensive and well-intentioned application of Band-Aids, but trying to dig deeper to try to figure out what are the root causes. So our aim is not just evening the playing field. Our goal is to repair the damage and allow those segments of society that we've pushed behind to catch up, because that's the only way we're going to have a sustainable economy moving forward.
So you're new to Chicago. Welcome to Chicago. I'm always, as somebody who's still relatively new, I'm always happy when there's somebody newer than I am, so I don't feel like the newest kid on the block. So you got here in the midst of the pandemic, so you haven't had a chance to experience all the wonderful things that Chicago has to offer. But you've done this work for a long time out in California. How different is it here? What are some of the lessons that you might be able to bring from your work there? And, what did surprise you the most as you started looking and understanding how the wealth inequality here in Chicago?
Yeah, I've done work around the country enough to realize that it's always dangerous to make comparisons. But there are some similarities and there are some stark differences. California, maybe not everybody knows, is a fairly fragmented state. It's huge. But we have a secessionist movement up in Northern California wanting the state of Jefferson. We've voted multiple times to divide the state up in half, right down the middle between North and South. The Central Valley feels very disconnected to the rest of California. It's much redder than the coastal areas. And obviously there's a great divide with regard to water economy and baseball teams between the North and the South. Economically, though, it's a very difficult market to be able to try to think about an economic strategy because there are so many different economic microclimates. So it's a very tough job for Governor Newsom and others to be able to start thinking strategically about the wealth gap and about egalitarian economic development, because you're dealing with what could be multiple states anywhere else. Chicago, I have found, is much more fragmented than I realized. I've done work here. I've visited many times. I've always enjoyed my time here. But just in the last few months, I've started realizing exactly how starkly fragmented by ethnic and racial lines the city really is. I'm still trying to scratch my head and understand the concept of aldermanic prerogative, which doesn't sound very democratic to me, but maybe that's something I need to learn here in Chicago. And it forces a strong mayor system in Chicago that I'm not sure anybody really had a say in. And that creates its own complexity in trying to tackle the challenges that are so prevalent here in Chicago. One of the first things when I got here I wanted to do was to get a snapshot of the city. One of the things that I noticed that I love doing in different cities, and it's always depressing, but here it was the most startling thing I've seen in a long time. residents' access to health care and health services is typically determined by where you live. So I just started typing in zip codes and looking at life expectancy gap. I found the life expectancy gap of somebody who was born today in Streeterville to average 90 years, which is wonderful. 9 miles down the road in Inglewood, 60. That's a 30-year gap. I don't think I've ever seen anything like that. To me, that is absolutely
in the country. It's the largest in the country.
Yes, I think it is. As I said, I've never seen anything like that beforehand. 1/3 of Black households have zero net worth. Zero net worth. So they were already struggling paycheck to paycheck before the COVID even showed up. 27% of Latino households have zero net worth. That is a very high number. So it's not necessarily an issue of what we need to do to be able to build equitable economic health. We have a lot of ways just to get out of a hole here. And there's a lot of work to do that requires policy, politics, and the private sector to all come together with a shared vision. It's not going to be easy. We've done it before in this country, but not on this topic.
So you mentioned some of the data as it relates to the Latinx community, and we've talked to both of you a lot about the wealth gap as it relates to African Americans. I know McKinsey hasn't yet done a specific study in the same way, but I know that McKinsey has been looking at this issue. Do you want to? Is there anything that you yet done that focuses on the same gap when it comes to Latinx community and some of the issues that you found in that?
Yeah, as you said, we haven't done the same look for the Latinx community, but we have looked at it in a couple different places. So I co-authored a piece on minority-owned businesses in the context of COVID-19 and some of the challenges that those businesses are facing, and Latinx is obviously a big portion of that. And what we found there is that very similar issues, lots of over-concentration in industries that were going more likely to be disrupted by the pandemic, similar issues with respect to access to capital. And so very much, at least in the preliminary work that we've done, there are many similarities with respect to some of the barriers. And I suspect that we'll find even more similarities as we get deeper in the research, and probably some differences as well.
Yeah, Horacio.
On the Latinx piece, I am still trying to understand a little bit more of the market here. I know that it has a tremendous Mexican American community here, a long history, but a lot of the numbers that I see within the Black community are essentially mirrored in the Latinx community. We are digging into this, with some help with regard to access to financial services. I took a tour just last week, masks and all, of the Humboldt Park region with the CEO of Bickerdite Development Corporation, or Redevelopment Corporation, Woman Joy. Just absolutely fantastic work that they're doing. And along the major business corridors that I saw, both of them on both sides of the park, I didn't find a single financial institution that was visible. So I also visited the Austin neighborhood. It's on my way home on the L. And I'm trying to get to understand the city a little bit more. So as I take the train, I get off at certain stops and start walking around and trying to look at the lived experience. Similar issue. There are thriving small businesses, but I'm not quite sure where they're fitting into the broader economic stream. I don't see many financial services. A little bit down the road in a more affluent area, I see banks, I see healthcare services, I see a lot more infrastructure. So right off the bat, that shows me exactly what the values are and where the infrastructure money is going in terms of how we're supporting these communities from an economic health perspective. And it's quite stark.
Yeah, it's interesting that you say that you're stopping at different stops and getting a chance to see the neighborhood. One of the questions I get asked the most from people who are trying to start on this journey of just understanding these issues, is how can I get a sense of this more. And one of the things I just always try to encourage people, just get out and walk through the neighborhoods and observe the differences between what's available in one neighborhood and what's available in another. And I think it starts telling the story in a more humane way and in a more human way than all of the data and the statistics that we often talk about. So it's great that you're doing that. We've talked a lot about the problems, and maybe it would be good to talk a bit about the solutions. And I think that there's a range of ways in which we can make a difference. And you started talking about some of them, Shelley. And I think we have clearly business has a real role to play, but so does policy. So maybe each of you say a bit about how you're thinking about solution sets and where do you think that we can make the biggest difference, including, and I go back to some of the comments that you made, Shelley, about if you're starting further behind, what is it going to take to ever catch up? And how are we thinking about closing some of those gaps in ways that can make a sustained difference? So I'll start with you, Shelley, and be good to get your ideas about solutions.
Yeah, absolutely. One of the ideas that I like the most, because it addresses a few different major roadblocks or traditional barriers, if you will, is really surging capital and know-how to MDIs and CDFIs. This whole capillary banking system, as it's often called. I think there is a huge opportunity to really help to rebuild these institutions, strengthen them, start new ones with people who are in these communities who have a vested interest in getting it right. And it creates capital for businesses. It creates capital for individuals to do things like home ownership. It creates jobs. So it starts to be a real flywheel. And I think that these institutions have been underinvested in historically. And so there's both a capital component to expand the lending capacity, and then there's a capability building component where investment is required. That will be a high ROI investment for everybody who's involved. So that's one. The other one I often think about is the education piece of this. There is a large educational funding gap in poor communities, in particular in communities where a lot of Black and brown Americans live. And we have to address that gap if we're going to actually up not just educational attainment levels. Often people say, well, the way we think about it is percentage of people who went to college or got a 2-year degree, but not all education is equal. So it's both the quality of education as well as then accelerating educational attainment. And there's a number of different ways that you can do this on the K through 12 side, as well as some of the creative ways you're seeing now be announced on the funding for higher education, et cetera. So those are two areas that, there's a longer list, but I'll stop at those two and turn it over.
Well, let me just ask you, though, on business, if you're a lender, you can do that. But if you're just an average business, what can an average business do that isn't a lender?
Yeah, absolutely.
Yeah.
Well, look, on the CDFI thing that I mentioned, Netflix, they were one of the early people that actually came out, and they're obviously in a completely different space. And they said, we're going to support these institutions because we think that it will have a knock-on effect for the economy. So my push would be that there is still an opportunity to support things that are even not in your direct remit if you think that they'll have big impact. But there's lots of things you can do as individual organizations. I'm going to set aside the internal diversity, equity, and inclusion efforts, which I think are critically important. But if I think about something like vendor diversity, and I mean that not just in some of the traditional supplier diversity areas, but expanding into professional services, which is very much untapped. So whether it's your law firms and your tax firms and your auditors and your money managers, how are you being expansive and thinking about equity and just using the way you operate your business as a lever for driving more equitable outcomes. I think that is a huge opportunity. If you think about how you as a company choose your location strategy, where you situate your business, whether it's your headquarters or some call center or a facility, has huge implications for who benefits, both from the jobs that are created and the knock-on investment that happens in those communities. So those are a couple of the examples that I've been talking about with clients.
Yeah,
Let me
no,
build off
exactly.
of
And some of those
that.
are very practical things that people can do if they just, with a different mindset of, how can we be part of this solution?
Could I build off
How,
of that for?
yeah, please. Yeah.
I think a couple of the things that Shelley said were spot on and very well said. Let me give you an example with regard to some of the externalities of what businesses can do. I had worked with the university on creating a mapping system that took a look at the granular level of communities from a geographic perspective and also from a person perspective. And we were working with an economic development committee and the mayor of a town on what that data showed. And there was a portion of that city that showed very stark difference between business and income opportunity from a geographic perspective. But from an individual perspective, it had very low income outcomes. And we were concerned about that. And initially, we just thought it was an error. When we decided to, as you said, there's some value in getting to the street, visit that location and start talking to people there, what we realized there were some companies that have moved into the area that had very good paying jobs, which was great for the city. The problem is that nobody from that neighborhood got any of those jobs, and they were stuck in low wage jobs. As a result, we partnered with the Economic Development Agency and the mayor to be able to have a workforce development strategy specifically to that place. A business that moved into an area should think about where they're going and what kind of value they can add to that neighborhood above and beyond simply the economic engine for the overall city. So those are some that sounds easy, but it's a little bit more complicated because you need to have both the information from which to identify that discrepancy, but then also the willingness to be able to work and start thinking about building that talent pool locally that can really have a long-lasting effect for the generational wealth in that neighborhood.
So, one of the things that I know you have focused on at Woodstock and throughout your career is really on policy change. And you started out talking about some of that. So say a bit about what are some of the policies that you think could make a difference, and what are some of the things that you're working on that you feel could add to some of the other sort of more programmatic efforts that are going into closing the racial wealth gap?
Yeah, thank you. There are a variety of different policy perspectives on this issue. Obviously, politics is not always the best solution to society's problems, but it does seem to get the lion's share of the brunt with regard to do something about this problem. We are, as I mentioned, focusing with regard to the financial services products that strip wealth from communities. The low-hanging fruit there is predatory lending. There are, according to a Google search that I did on my map, so it's very sophisticated, more check cashers and payday lenders in the city of Chicago than open Subways and Starbucks. That's a problem. We certainly can't end the use or the need for payday loans or predatory loans, but at the same time, we can try to work with the industry and with regulatory agencies on regulating it and minimizing the damage by putting a cap on the interest rates, and B, trying to create some competition from some more responsible players. On this, I'm going to make a shout out to Bank of America, which just recently announced something called Balance Assist, which is a payday loan, essentially $5 flat fee for up to $500. It's that kind of thoughtful and innovative thinking that can really make a big difference and sometimes have to circumvent the policy and the regulatory aspect, which we all know can have unintended consequences. Other issues right now, and the Washington, D.C. and the federal level, is one of the major financial services regulations with regard to wealth building, which is the Community Reinvestment Act. The Department of Treasury has come out with their own rules on that for some of the largest banks in the country. We disagree with many of the aspects of that and may actually create an unintended disinvestment in CDFIs and community development financial institutions and minority development institutions. The Federal Reserve has come out with their own. And while I'm very excited that the governor that came out with this will probably be the Treasury Secretary, I'm a little bit upset that she may leave the Fed and lead this charge towards really taking a much more race-forward look at a banking regulation that for the most part has only been income-based, but we all know the connection between the two. So we're very actively engaged in working with financial institutions and our advocacy partners, and partnering with the Federal Reserve to think, how can we be much more thoughtful about the systems change that needs to happen? And by systems change, I'm really talking about not throwing more money at the problem. So when you have a financial institution that gets in trouble for not making enough mortgage loans, let's say in Chicago, the answer isn't saying I'm going to put billions of more mortgages into the city of Chicago, because the entire infrastructure of the mortgage process has baked in it a variety of very unfortunate realities that work against minority communities. So really the goal here is to dig into the process that includes appraisals, title, zoning, the infrastructure of those communities, the use of taxpayer money for infrastructure, roads, schools, education, parks, all of these things, trying to create an infrastructure from which race is not as much of a determinant factor over the value of your home than it is right now, which is at its highest level ever.
So you kind of alluded to some of these policies that could have a major impact, but that if they're done in the same way, could continue and perpetuate. And there's some of the inequities, and there's been debates about whether or not policies that are race neutral can actually fix things that are race specific. And so what's the balance on that, understanding that it is oftentimes difficult to do something that has a specific racial target to it, nonetheless understanding the links, as you said, between that. How have you thought about those issues, the balance between race neutral versus race specific policies?
The interesting thing is that, at least in this case, with regard to the act that I was talking about, the Community Reinvestment Act, the first wave of regulations that was associated with this was much more race forward than the current regulation is. So I had come into the Federal Reserve and worked on the revision in the mid-1990s of the CRA regulation, and actually found one of the assessment factors very specific to race. So even though the act itself was much more focused on income, the regulatory agencies, all four of them at the time, found that connection and were able to be much more race forward. When the regulators revised the regulation in the 90s, it seemed like a very difficult dance to make or to perform. And as a result, took those sections out. I don't think it's that much of a stretch to put it back in. And it doesn't take that much courage. I think when you take a look at some of the other regulatory and policy changes, I think we just need to be honest with ourselves about what we really mean when we have income-based regulations and policies. What's written on paper may be one thing, but I think in terms of how it gets implemented, we need to be much more race forward.
So, Shelley, what are you most concerned about? You've done this great analysis. You've looked at what some of the issues are, and you've also put together some real solutions that you think can make a difference. But as you yourself said, we've thrown a lot of money at these issues, and we still have a big problem. So what are you most concerned about won't happen? Where do you think some of the greatest impediments are, and how can we all be thinking about this time being successful in our efforts to close the wealth gap?
A couple of thoughts there, and they maybe come from different places. The first concern that I have in having this discussion is not being articulate enough to land the point that this is not zero sum. I think there's a tendency in this discussion for sometimes some audiences to interpret it as, if this subgroup does better and gets more resources, this other subgroup, by definition, will have less. But that's not the way the economics or the math works. And so my big concern is that we missed the mark on conveying that this is really a rising tides lifts all boats situation that we all should be excited to address. That's one. The second is more immediate in this moment, which is, I don't know the final number, but we've cataloged tens of billions of dollars in commitments that have been announced over the last 5 weeks, accelerating out of what's been happening with COVID and George Floyd and Breonna Taylor and others. And my big concern is that's money wasted. And I don't mean that in a negative way, but it's just such an opportunity now to funnel resources toward things that are high ROI. And we just need increased coordination, collaboration, and we need institutions to hold one another accountable for the commitments that they're making. I'm not yet seeing the mechanism for that. And that's something that we've been having a lot of discussion about with our clients.
I see David coming back. Can I ask Horacio that same question?
I loved what Shelley said. From his mouth to God's ears is what we can hope for. I have very similar concerns, plus one, so that way it'll be quick. My concern is that people don't see the relationship between their lives and the lives of others. That this window is closing and that the rage slowly subsides and we go back to how we were before. That's my greatest fear.
All right. Does that mean we're out of time?
It does, Helene. We could go on for a long time, but I want to thank you. I want to thank Shelley and Horacio for just an energetic, informative, and thoughtful discussion. We could not have asked for a better panel. So thank you all.